Very good evening to all of you. So today on the last head of income we are going to discuss uh, the income from other sources. The last residuary head of income we are going to take it up for discussion now. So guys, in case of income from other sources, the chargeability section is a little important one. There are certain things which we need to discuss here for chargeability on the income from other source. So income from other sources, the dividend income, all kinds of dividend income, including deemed dividend, is chargeable to tax under that income from other sources. All kinds of casual income, that is betting, gambling, winning from lottery, all kinds of casual income will be taxed under that income from other sources. When the legal heir receives the keyman insurance compensation, that also will be taxable under that income from other sources. Agricultural income from a land situated outside India is also taxable under this head, uh, because agriculture land in India is exempt under section 10(1) or proportionate exemption is there. All kinds of interest, including interest on compensation, enhanced compensation, is also taxable under this head. And gifts received from any person, for the receiver of gift, it's an income, and such gift is taxable if the gift is above 50,000 rupees. So three types of gifts are there: cash gifts, movable property, and immovable property. Three types of gifts are there. So any of these three types of gifts are taxable in the hands of a receiver. But the condition is when movable and immovable property is received as gift. When movable and immovable property is received as gift, then that must be capital asset. That must be capital asset. If it is not a capital asset, then it's not chargeable to tax for the receiver. Then closely held company receiving consideration over and above the market price, that is the premium on the shares issued, will be taxable. Advance money received forfeited provided the forfeiture is on or after 1/4/2014. Then any kind of compensation received relating to this is the same in the chargeability of profits and gains of business or profession also. Same thing here also. Any compensation received due to termination or modifications in the terms and conditions of the contract of employment, that will also be chargeable to tax. Here the word employment means not having employer-employer relationship. Not having employer-employer relationship, and most importantly, any other income which is chargeable to tax but not taxed in other heads. That means a revenue income which is not a salary income, not a house property, not a business profession, not a capital gain, will automatically be charged to tax under the head income from other sources. Later we will study on the violations of Chapter 6A, where we have some violations of Chapter 6A. So Chapter 6A violations will be taxed under this head. So we'll when we go to Chapter 6A violations, that time we will take a look at that. So with respect to gift, there are some exceptions. Even though the gift is received, which is beyond 50,000 rupees, still it will not be taxable in some situations. So what are those situations? We will take it up now. So now, the gift received from any relative on any occasion. Gift received by a person for the receiver on any occasion. The gift, if it is received from relative, what is relative definition? That we will discuss in a short while. Gift received from relative is not chargeable to tax. Same way, gift received on the occasion of marriage from anybody, relative or non-relative, even though gift is received from non-relative, the gift amount, even though it is more than 50,000 rupees, only on the occasion of marriage is not taxable, even though it is more than 50,000. Sometimes to confuse you in the examination questions, they will tell gift received on marriage anniversary. So ignore all those things, and you should take only on the marriage it is exempted. Marriage anniversary and all, it is taxable if the gift is above 50,000 rupees. Only if the gift is received on the occasion of marriage, then it is not taxable, even though it is more than 50,000 from anybody. Other points are there: will, inheritance, contemporary of death, local authority, so many other things are there, but they are not important for exam, so I'm not taking up. So I'll move on to the concept of relative. Relative, here the word relative means what? Spouse of the individual, brother, sister. So if we take assessee is Mr. X, Mrs. X, brother and sister of Mr. X, brother-in-law, sister-in-law also is a relative. Parents, brothers and sisters, that is uncle, aunt, and all those things. Fathers and mothers, brothers and sisters are also covered here. Lineal ascendant, descendant, we have already discussed in general definition. There also lineal ascendant and descendant are covered. Lineal ascendant and descendant of spouse, that means father-in-law, mother-in-law, brother-in-law, they are definitely covered. Lineal ascendant and descendants of spouse, obviously son, daughter, daughter-in-law, everybody covered. And all the spouses of the other points are also covered here. And in case of Hindu undivided family, any member of Hindu undivided family will be a relative. So here the scope of relative is wider. So if gift is received from relatives up to 50,000 rupees, such gift is definitely chargeable to tax. I mean, such gift is exempted from tax. So if gift is received from relative, it is always exempted even though it is more than 50,000 rupees on any occasion. On any occasion, if gift is received, it will be exempted. Okay, so these are all the points on the gift. So any questions you have, please ask on the chat box. That will be great if you let me know if it is there. Any questions on the chat box, please. Then let us move on to casual income. There are some points on the casual income. Casual income covered under section 115BB. The taxability of casual income is flat, flat 30%. Flat 30% means no basic exemption will also be covered. No expenditure will be allowed as deduction, no chapter 6 deduction, no set off and carry forward of losses, nor casual income can be used to set off any other losses, including unabsorbed depreciation, nothing. Casual income is always taxed at a flat rate. Casual income is always taxed at a flat rate, and basic exemption also not available. Okay, so I've given a summary table on the gifts received. When it comes to gifts received, guys, cash gifts should be more than 50,000. Aggregate total cash gifts received will be taxable. And when it is immovable property free of cost received, single property, single transaction is covered. For each transaction, if it is more than 50,000 for immovable property, taxable. uh, and it must be stamp duty value which is taxable, and such stamp duty value must be 120% of the sale consideration if it is for inadequate consideration. Inadequate consideration, if it is exceeding 50,000 rupees, is taxable, but the inadequacy must be 120% of the sale consideration. That means the money recovered into 120%. Then you compare it with guideline value. If the guideline value is higher, then that guideline value will be taxable. Okay, so same is the case with movable property. Single transactions are covered, I mean, single transactions are not covered here. All transactions are covered like cash gifts. Movable property, again to remind you, movable property must be capital asset. If personal car, personal vessels, table, chair, furnitures are given, that is not chargeable to tax. Only it must be capital asset. Only capital asset is chargeable to tax. Okay, then there are some admissible expenses while computing the head income from other sources. Those admissible expenses are similar to profits and gains of business or profession, where any expenditure is incurred to earn the dividend income or interest income is allowed as deduction, but there is some restriction. I'll come to that. Then all expenses incurred to earn an income, any expenses incurred to earn an income will also be allowed as deduction except 115BB. Then when assets are leased out and lease rentals are chargeable under this head, that is income from other source. Repairs, insurance, depreciation, all those things are also covered here. Family pension, one third or 15,000, whichever is lower, but alternative tax regime opted, then this deduction is not available. Any expenses, this is an important point, any expenses incurred to maintain race horses is allowed as deduction. So interest on compensation, enhanced compensation, flat 50%, no other deduction will be allowed. Sometimes to confuse you, they'll give you lawyer expenses, and they'll bifurcate the interest also. That year this much, this year this much, but whatever total received in the year of receipt, if the interest on compensation, such interest on compensation, flat 50% deduction, no other deduction. The limit on dividend income and mutual fund is subject to a maximum of 20% of the income. The deduction of expenditure, actual expenditure on interest on mutual funds and all those things, dividend income will be restricted to 20% of such income. Okay, inadmissible expenses, again the same thing like profits and gains of business profession, personal expenses, wealth tax, income tax, not allowed as deduction. Any expenses incurred for which tedious violations have been done, same like 40A, that also not allowed as deduction. Casual income, there is no question of deduction at all. Any expenses incurred where the expenses are paid in cash, the expenses paid in cash 10,000 or 35,000, same like 40A3, all those things are to be covered. Guys, one thing you have to remember is whenever there is any income which is given to you net of TDS, please add back the TDS and gross it up. This is a very, very important. Gross income, that is after TDS, gross income will be considered. On the gross income, tax liability will be computed. Then compare with TDS done. If TDS is more than the tax liability, assessee can claim refund. If TDS is lower than the gross tax liability, then the difference amount has to be paid by the respective assessee. Any questions, please let me know. Okay. Other unexplained expenditure, cash credits, all those things are also covered here and it will be taxed under this head, income from other sources. Unexplained expenditure, unexplained investments, cash credits, they are all taxable here. And let me tell you, taxable under section 115 BBE is at the rate 60% plus surcharge 25% and cess 4%. Okay, so these are all the various heads of income. Guys, income from other sources can be clubbed and asked with any head of income. This can be clubbed with any head. Only thing is this chapter is very small, so the corresponding independent provisions you need to remember and apply them accordingly. So if you have any questions on this, please drop it on the chat box, please. So if you have any questions, please let me know. We can discuss it out on the chat box, please. Thank you. Okay, let me take you through the clubbing of income. Clubbing of income is the next chapter that I have to take you through. So clubbing of income, first of all, when income alone is clubbed without transferring the asset, clubbing will be applicable on the transferor. Revocable transfer is always attracts clubbing. Irrevocable transfer, clubbing does not attract. Okay, clubbing will not be attracted if it is irrevocable transfer, and if it is transferred to a trust and it is irrevocable and it will never be revocable for the lifetime of beneficiary, then clubbing will not attract. These are the exceptions. Only for irrevocable clubbing, irrevocable transfer, clubbing will not attract. So now let's take up clubbing of spouse income. How spouse income will be clubbed? So sometimes what happens is husband transfers a property free of cost to wife or wife transfers to husband, whatever. In those circumstances, for the transferor it will be clubbed. So where a asset is transferred, where an asset is transferred, where an income arising from an asset is transferred, that now for example, Mr. A gifted a property to Mrs. A which was deriving rental income, or cash is transferred where she deposits that money and interest income is derived. So wherever after receiving the gift, wherever an asset is received and from that asset when the income is generated, that income will be clubbed in the hands of transferor. Okay, so there are two exceptions to it which is very, very important. If clubbing is clubbing is not attracted if the gift is given with an agreement to live apart. Agreement to live apart means where the husband and wife are getting divorced. So husband and wife are getting divorced, and because of divorce, some property or something is transferred, and there is no question of clubbing in those circumstances. Same way, clubbing is also not applicable where money is given for household maintenance by the husband, and from that money, if some savings is done by the spouse, and the spouse deposits in some money and earns some interest income or anything, then also clubbing will not be attracted. Then coming to other clubbing of income, if any salary, bonus, commission is paid by one spouse to another spouse, for which the other spouse is not rendering any services, even in those circumstances also clubbing will be attracted. Now, for example, if Mr. A is a lawyer and lawyer debits a salary to spouse, and salary is, I mean, the spouse is actually not rendering any services, in those circumstances, the spouse will be, I mean, the expenses debited will be clubbed back to him. Okay, so if there is a concern in which husband is having a substantial interest, and let me recall you, substantial interest means 20% or more, which we have studied in the salary chapter. So it's 20% or more substantial interest is there, and then some expenses are debited, it will be clubbed back. But clubbing will not be attracted. This is a very, very important exception. Clubbing will not be attracted if the spouse is actually rendering services. That means if that expenditure is attributable, the salary that is paid, salary, bonus, commission, that whatever is paid by one spouse to another spouse, is attributable to some professional qualification, skill, talent, knowledge, experience, etc., then clubbing will. That means if actually services are rendered, definitely clubbing will not attract. It will be taxable in own hands. Okay, and where there is a concern, let's say a company and both of them are having substantial interest, like their directors or something like that, in those circumstances, when the salary is paid to both of them, check the other income. Whosoever other income is greater, then the income from such concern will be clubbed in the hands of. So if check the other income of Mr. A and Mrs. A, who are directors of X Limited, and when X Limited is paying salary to both Mr. and Mrs. A, you should see the other income of Mr. and Mrs. A, whosoever income is greater. If Mr. A's income is greater, then Mrs. A's salary from X Limited will be clubbed in the hands of Mr. A. In other words, if the income is equal, if the other income is equal, clubbing will fail. Clubbing will fail. So these are the provisions of clubbing of income, and all other relationships are also covered. Father-in-law, mother-in-law, daughter-in-law, son-in-law, they are also definitely covered in case of clubbing of income. So guys, if you have any questions, drop it on the chat box, please. Very important section is income of minor. Income of minor, section 64 1A, very, very important provision. So income of minor will be clubbed in the hands of that parent whose income before clubbing is greater. If minor is there who earns some interest income and all those things, and minor income is clubbed in the hands of that parent whose income before clubbing is greater. That means father's income is greater, means the income of minor will be clubbed in the hands of father. If the income of mother is greater, it will be clubbed in that. That means if both father and mother income are equal, clubbing will fail and taxed in own hands, minor hands. Then once the clubbing starts, it will continue with the same parent generally, unless the assessing officer considers the change as necessary. Also, income of minor is not clubbed. Very, very important point. Very, very important point is that minor's income is not clubbed if the minor is deriving an income from own skill, talent, knowledge, qualification, experience, all those things. Now, for example, sometimes minors act as child artists in movies, advertisements, and all those things. So, in those circumstances, such income will not be clubbed, it will be taxed in own hands. But if the minor deposits the money in a bank, and from that bank, if the minor derives an income, that income will be clubbed in the hands of minor. Okay, and once minor's income is clubbed in the hands of any parent, such parent can claim an exemption under section 1032 up to a tune of 1500 per minor child. 1500 per minor child, but this exemption is not available if the parent opts for 115 BAC. Okay, so 1500 is per minor child. It is per minor child, it is not per income. So if unutilized exemption is there, I've already told you in one of the past classes, unutilized exemption is there. Now, for example, if 1000 rupees only is clubbed in the hands of father, and there is another minor, additional 500 cannot be used to the other minor child. It is per minor child. And also, when when parents have got divorced, then there is no question of clubbing. Whoever maintains the minor child, the minor child, whoever maintains, the clubbing will apply to such parent. Minor child includes stepchildren, adopted children, and minor married daughter. Minor married daughter's income will be clubbed in the hands of parents. It will be clubbed in the hands of parents, not husband. Okay, So same is the case with other minors also. Minors income will be clubbed in the hands of parents whose income is greater. Minor married daughter income also will be clubbed in the hands of parents whose income is greater. It will, just because she is married, parents, it will not be clubbed in the hands of husband. Okay. So these are all the various situations on minors income clubbing. Please let me know if you have any questions, if any. Okay. Hindu undivided family, sometimes what happens is some people transfer a property free of cost to Hindu undivided family. So if those situations happen, then Hindu undivided family clubbing will attract to the transferor. And sometimes after transferring to Hindu undivided family, after some years, the partition takes place, and after partition, it will be transferred to spouse or somebody else. Then also, if Mr. A has transferred a property to Hindu undivided family, and after that partition happened, and in that partition the property will transfer to Mrs. A, still clubbing will happen with Mr. A only. Still clubbing will happen with Mr. A only. These are all the various points on the clubbing. So let me talk about other points on clubbing. Income from asset transferred is clubbed and not income on income. Now, for example, if Mr. A has transferred 100 shares to Mrs. A and Mrs. A is deriving dividend income, that dividend income will be clubbed in the hands of Mr. A. But later the company allotted some bonus shares, and because of the bonus shares, if the company has which has allotted bonus shares, the company on that dividend, that will not be clubbed. Income on income will not be clubbed. Only the income will be clubbed in the hands of the transferor. If capital asset is sold, capital gains will get attracted. That is very important. And another important point is, at the time of clubbing, at the time of transfer and at the time of generating of income, the marriage relationship must subsist. If relationship is not there at the time of earning the income, then the clubbing will fail. It will be taxable in own hands. And income includes losses that we have already known and discussed in the beginning of this income definition. Any questions you have, please drop it on the chat box. I'll be most happy to answer all your questions. Thank you. Let's go to set off and carry forward of losses. This is the last topic of the day. Uh, Set off and carry forward of losses, which we will do it from section 70 to 80. Well, first thing is, you must know that there is something called as loss under the four heads. Income from salary can never have a loss. Casual income can never have a loss. So other four heads of income can have a losses. So in those circumstances, how to knock off this? First thing is, you have to knock off the losses within the same head, and then you have to go to the other heads. But not all losses are allowed. Some exceptions are there. Other than these exceptions, any other intra-head adjustments are allowed. So first you should do the current year losses, then you should go for brought forward losses. Same way we will study the provisions of the law also, where there is an intra-head adjustment done, how it is done and where exceptions happen. So speculation loss cannot be knocked off with other head. That means speculation loss can be knocked off only with speculation income. Loss from specified business also can be knocked off with such income. Long-term capital loss can be knocked off only with long-term gain. And loss from activity of owning and maintaining resources can be knocked off with such income. Then any loss which is arising from an exempted source cannot be used to knock off any losses. Okay, and casual income can never be used to knock off any losses. So these are all the exceptions. Speculation loss and loss from activity of owning maintaining resources is very, very important. So this is what first you should do, the intra head adjustment within the same head. Other than these exceptions, any other combination is allowed. Now for example, if Mr. A is having a loss from house property 1 and income from house property 2, yes, it can be knocked off, it can be set off. So other than these exceptions, any other combination is allowed within the same head. Now moving on to losses from other heads. That means current year loss is there even after locking off within the same head. Still, if there is a loss, how this can be knocked off with other heads? So if these exceptions which is there for intra head adjustment exceptions are there, means the same thing will be there for inter head also. So inter-head adjustments, what are not allowed is loss from business profession. Loss from business profession cannot be knocked off with salary income. It can be knocked off with house property. It can be knocked off with anything else. But salary income, it cannot be knocked off. Same way, speculation loss, specified business loss, capital losses. Short term or long term losses, if it is there, it can be adjusted within the same head, but it can't be adjusted with other heads. Same way, loss from activity of owning, maintaining resources also cannot be knocked off with other heads, and loss from house property can be knocked off with any head, but maximum loss that can be knocked off is 2 lakhs per annum. Maximum loss is 2 lakhs per annum. So these are all the intra head adjustment and its exceptions. So please let me know if you have any questions. Then coming to brought forward losses, headwise we will take it up. Section 71B, loss from house property can be all brought forward losses. All brought forward losses can be knocked off only within the same head. It can't be adjusted with other heads. So brought forward loss from house property can be knocked off only with current year income from house property, and maximum that can be carried forward is 8 assessment years. Business loss also the same thing. Business loss also, brought forward business loss can be knocked off only with current year business income and maximum 8 years. However, the exception is fresh 8 years is available subject to certain conditions where there is a business on inheritance, amalgamation, etc. The fresh period of 8 years is there. So there is a methodology how to knock off the losses. The losses can be knocked off. First, you have to knock off the current year depreciation, then current year capital expenditure on scientific research, then you have to brought forward business loss. Unabsorbed depreciation will be later, then unabsorbed capital expenditure on scientific research and family planning expenses by the company. So these are all the methodology, systematic way only you can knock off. If there is no other methodology, you have to knock it off in the same order. Okay, so so speculation loss can be knocked off only with speculation income, and it can be carried forward for maximum 4 years. Carry forward of losses of capital gains, yes. Long term loss can be knocked off only with long term gain. Short term loss can be knocked off with long term or short term gain. But maximum it can be carried forward for 8 assessment years. Activity of owning and maintaining racehorses only with such income, 4 years it can be carried forward. Specified business loss can be knocked off only with specified business income, and it can be carried forward for indefinite period. Okay, unabsorbed depreciation can be knocked off with any head except income from salary, and it can be carried forward for indefinite period. Loss from an exempted source cannot be. Now, for example, what do you mean by exempted sources? If assessee is having a loss from agricultural income, that's called as exempted source. Partner having a share of loss from the firm is loss from an exempted source, because had it been a positive income, assessee would have applied the exempted provisions like section 10(1) or 10(2)A respectively. Okay, most important point is, if assessee wants to carry forward any losses to the subsequent year, returns have to be filed on time. Returns have to be filed on time. If returns are not filed on time, then losses cannot be carried forward to the next year. So if losses have to be carried forward, returns have to be filed on time. However, if assessee is having only house property loss and unabsorbed depreciation, even though returns are not filed on time, it can be carried forward to the subsequent year. So any questions you have, please let me know. Uh, I've given an explanation here on the speculation business. So any questions you have, please let me know. Okay. Now let us go to chapter 6A deductions. So chapter 6A deductions starts from section 80C to 80U, and only section 80C, 80C I'll be taking you through this, and 80C I will do it. 80D onwards we can defer it to the tomorrow's session. 80C onwards we'll do it. First of all, 80C is applicable to individuals only, and premium paid up to the limits of section 1010D. Premium paid up to the limits of section 1010D is available. That means policy taken on or before 31st March 2012, 20% of premium only is allowed as deduction. Policy taken on or after 1/4/2012, premium paid up to 10% only of the sum assured is allowed as deduction, and premium paid will be allowed as deduction restricted to 15%, policy taken on or after 1/4/2013, and for ATU and ATDDB policies. And the other conditions are, policy must not be surrendered up to within 2 years. Within 2 years, if the policy is surrendered, deduction claimed earlier will be taxable in the year of violation under the head income from other sources. ULIP, unit linked insurance plans, are also covered here. They are also covered here. Assessee, whatever premium he pays can be claimed as deduction. Employee's contribution, employee not employer, employee contribution to provident fund, superannuation fund, etc., public provident fund is allowed as deduction, provided it must be free from encumbrance. That means it not be pledged anywhere, and it should be in the name of self-spouse children only. It should be in the name of self-spouse children only. In case of life insurance, policy can be taken on self-spouse children. Parents are not covered, in-laws are not covered. All other investments must be in assessee's own name only. If it is in the name of daughter married son, they'll give. Please don't give any kind of deduction. All tax saver deposits must be in assessee's own name only. Okay, senior savings citizen scheme, 5 years term deposits with bank or post office, then deposit in Sukanya Samriddhi savings scheme account, all those things are allowed as deduction. NPS tier 2 only, NPS tier 2 only, the two not less than 3 years. That means 3 years or more, 3 years or more by the central government employees, they are covered here for NPS. And any withdrawal is made which is premature. Now for example, 5 years deposit was made for a fixed deposit and assessee withdraws within 5 years, very sorry to say both interest and principal will be taxable in the year of such premature withdrawal. It will be taxable. Principal repayment on housing loan is allowed as deduction. To remind you, interest under section 24B, so here only principal will be allowed as deduction, but provided the loan is borrowed for purchasing a constructed property or for the purpose of construction. That means loan borrowed for repairs, renovation, reconstruction, the deduction is not allowed. Also, loan borrowed from friends and relatives, no deduction available. Okay, so these are all the provisions which are there. Principal repayment, no interest, because interest is covered under section 24B under the head house property. Also, once assessee claims 80C deduction, the house property on which the deduction is claimed has a lock-in period of 5 years. Within 5 years from the end of financial year in which the possession or completion of construction is done, no deduction under 80C will be allowed if the such property is sold within a period of 5 years. If within a period of 5 years, if it is sold, then no deduction. That means, and also other deductions claimed in earlier years will be taxable. Tuition fees paid to the two children, not assessee's own education, two children will be allowed as deduction for a full-time course in India. So sometimes they'll give grandchildren and all, please no deduction, don't give any deduction. And also any kind of subscriptions in eligible issue offer is also allowed as deduction, provided those shares have a lock-in period of 3 years. The maximum deduction that can be claimed under section 80C is restricted to 1,50,000 per annum. All deductions, senior citizen savings scheme, tax saver deposits, premium, tuition fees, everything put together is maximum 1,50,000 only will be allowed. 80CCC is towards private pension plans. So when there is a private pension plan applicable only to individuals, when they subscribe and pay the premium, amount of premium paid will be allowed as deduction. But if any bonus, everything is adjusted, actual premium payment will be allowed as deduction. If there is a opting out of pension plan and money is received on surrendering a pension plan, it will be taxable in the year of violation, including the bonus, and all those things are there. That will be taxed under the head income from other sources. And and sometimes when a private pension plan is linked with life insurance, 80C and 80CCC both deductions not available. Okay. Then coming to NPS, most important section, section 80CCD NPS applicable only to individuals. If assessee is having NPS contribution and having salary income, 10% of salary will be allowed as deduction. If assessee is having other than salary income, then the deduction will be restricted to 20% of the gross total income. So salary for this purpose means basic salary plus dearness allowance. If forming part of salary for retirement benefits, no commission, nothing else will be considered. Only these two will be added for 10% of salary. Uh, if the assessee is a government employee, then the enhancement will be restricted to 14%. Instead of 10%, 14% will be there, and this deduction is available even if the government employee opts for alternative tax regime. Okay, and additional deduction on NPS is another 50,000. I'll come to that. If assessee all three sections, if assessee has 80C, 80CCC and 80CCD, all three sections put together will be restricted to 1,50,000. However, employer contribution, employer contribution to the NPS is over and above 1,50,000, and also Employee contribution is within 1,50,000 and NPS is additional 50,000. Actual amount deposited or 50,000 that will be allowed as deduction, which is over and above 1,50,000. So 80C, 80CCC, 80CCD 1,50,000 including employee contribution to NPS. Employer contribution to NPS is over and above the 1,50,000 plus additional pension plan subscribed under NPS 50,000 maximum deduction will be there. That means more than 1,50,000 also associate can claim deduction indirectly. Associate can claim indirectly. So if you have any questions, please deposit in the chat box. We can take it up from the chat box. Thank you. Okay. All right. Okay, fine guys. 80D is medical insurance premium. 80D is medical insurance premium, and four things are there: health insurance policy, contribution to central government health scheme, preventive health checkup, and medical expenditure on very senior citizen and very senior citizens. These are the four things which are eligible for deduction under this. Okay, so health insurance premium is maximum 5,000. My health insurance premium is allowed as deduction. Preventive health checkup is deduction is allowed up to 5,000 rupees. The maximum deduction is 25,000 if the assessee is not a senior citizen, and if the policy is taken on a senior citizen, then 50,000 will be allowed as deduction. Okay. However, the premium must be paid other than cash. Other than cash, if it is paid in cash, not allowed as deduction. All contributions, everything in other than cash only. Only preventive health checkup, because the deduction is restricted to 5,000, that can be paid in cash, no problem. Okay. Medical expenditure incurred on very senior citizen is also allowed as deduction. Senior citizen also allowed as deduction, provided it should be other than cash. Okay. A summary table I have given to you. In if you see, assessee is not a senior citizen, parents also not a senior citizen, 50,000 maximum. Assessee is not a senior citizen, but parent is then 25 plus 50, 75,000. If assessee also senior citizen, parents also senior citizen, 1 lakh is the deduction. Same is the case with medical expenses. If assessee is not a senior citizen, no deduction on medical expenses. Parents may then 50,000. If assessee also senior citizen, parents also senior citizen, medical expenses incurred 50 plus 50, 1 lakh will be allowed as deduction. Any questions? Please drop it on the chat box. 80DD assessee is not disabled, dependent is disabled. Dependent with disability. That means assessee is maintaining a person who is disabled. And here the disabled person must be spouse, children, parents, brothers, sisters. And they must be dependent on the assessee. That's very, very important. So if assessee has taken an insurance policy on such disabled person, then our deduction is there. And here it is a flat deduction irrespective of actual medical expenses. 75,000 rupees is a flat deduction if the disability is a normal disability and not a severe disability. In case of severe disability means 80% or above as certified by doctor. Exact 80% also severe disability. Flat 1,25,000 assessee will get a deduction. If the dependent who is disabled and dies before and they get a policy refund, then amount will be taxable. Already we discussed in section 1010D, no exemption. Okay. 80DDB. 80DDB, treatment of specified diseases. Here specified diseases are the diseases which is given in Rule 11DD, like cancer, some hematological disorders, all those things. So here, as a resident individual and Hindu undivided family, either assessee himself getting specified diseases or dependent getting specified diseases, the deduction is available. Where what is the amount of deduction? 40,000 rupees or actual medical expenses, whichever is lower, where the assessee or the treatment is on a not a senior citizen. For senior citizens and super senior citizens, the amount of deduction will be 1 lakh or actual amount of expenses, whichever is lower. Okay, specialist doctor certificate is very, very important, and doctor certificate has to be attached with the return of income. Okay. 80E is interest on education loan, only interest, no principal, up to 7 years. That means it starts from the year where the repayment starts, and deduction is maximum 7 years or till the repayment of loan, whichever is earlier. Only interest is allowed as deduction. Actual amount of interest is allowed as deduction. This is for education loan taken for assessee himself for higher studies or his dependent, spouse, children, anybody, or for a student where assessee is a legal guardian. Okay. 80EE is interest on housing loan. But this section has lost its significance because the loan must be sanctioned between 2016 to 2017. So since that is not in your year, I will directly go to 80EEA. Here loan must be taken from 2019 to 31st March 2022, and the individual must have taken a housing loan from a financial institution only, friends and relatives not covered. And the stamp duty value of the property must not be for more than 45 lakhs, and as on the date of loan, assessee should not have any other property. Maximum deduction is how much? Actual interest or 1,50,000, whichever is lower. Okay, and also this section 80EA or 80EE can be claimed over and about 2 lakhs or 30,000 for self-occupied property that we discussed in section 24B. Any questions? 80EB for interest on loan for buying electric vehicle. Electric vehicle, it must be purchased and loan must be availed between 2019 to 2023. And maximum deduction is actual interest or 1,50,000, whichever is lower. Let me tell you that when assessee purchases a vehicle, a electric vehicle, and applies 80EB deduction, then no other deduction allowed. The asset cannot be capitalized and all those things. Asset cannot be capitalized. No other deduction, depreciation benefit, repairs, maintenance. No other deduction will be allowed. Okay, so fine guys, 80G is a little big section and there are a very important section. 80G is a very important section. I will defer it to the next class, that is on tomorrow. We will meet up in the tomorrow's session and discuss the remaining portions of chapter 6A and assessment procedure, and we'll wind up the session in the tomorrow's class at the same time. Thank you.